All right. Give it a moment. Let everybody jump in. Hey, Delfino. Hey, David.
How's it
Good.
going?
Exciting to see everyone joining in.
Welcome, everybody. You want to just drop in the chat where you're dialing in from? I'll start us off. See if
Good.
somebody beats me.
We got a great group coming in. Looking
Yeah.
impressive. Impressive.
Oh,
Well, I
nice.
guess we've got a great topic going here. Richard,
Yeah.
this is a topic that is drawing a lot of attention.
I see one of
Yeah.
my good friends, Susie, is on. Hello, Susie.
Yeah, we got a lot of friends,
A
actually.
lot of people joining.
Yeah, Jim Harrison's on there, my good buddy Jim. One of the great warehouse lenders out there. So yeah, Jim, yeah, you can pay me later, Jim. Giving you a shout out, dude. Good friend. Love to see their friends show up. Isn't that good, Delfino?
Yes, it is.
Yeah, there's so many. Look at all the days. Oh my gosh, look at this. I love it. I'm impressed. Way to go. 63 and counting. Good deal.
All right. KP will join us in just a moment, and then we'll get started. Just give it a little bit more time.
Of course, yeah, we got South Star in there. Yep, I saw that. South Star comment. Yes. Excellent. Excellent. Yes. Excellent warehouse letter.
We have a big audience from Texas in there right now.
Yeah.
Yeah, I've got some Texas representation there.
Got that. It's good. Don't mess with Texas. That's where I'm at.
How cold is it in Texas right now? I heard
it's right at the moment. We're sitting at 69. It'll be 70 plus degrees today. It's one of those beautiful days. It was 13 degrees here recently. So, yeah, it's not, we don't have Southern California weather, except days like this is almost like that.
David, if it gets close under 50, the people freak out in California. So,
I had three. I was part of 3 mortgage banking companies out there in Southern Cal. So love the California. I was a California beyond, went from dreaming to living it, and it was a dream. Love it.
Yeah. All right. I think we've given it enough time here. I think we should kick into it. We got a lot to cover, a lot of polls, a lot of great content.
Jacksonville, Florida.
Really excellent panel lineup. So I'm going to share my screen and David, take it away.
All right. Very good. Let's get it started here. Thank you so much. I want to, first of all, welcome everybody. 10 ways, or you might say 10 strategies to drive revenue and reduce costs in 2024. If that doesn't draw you in, it kind of explains why we have 73 people so far dialed into this. I want to introduce our panelists. If we could go into the next discussion. It's a great topic. I'm excited about who we have joining us. If we could go to the next slide, please. And panelist joining us is Delfino. Delfino is a chief production officer and just probably someone I am getting to know. He's a podcaster. That's a man after my own heart. He's chief production officer, TPO of a TPO at Kind Lending. So good to have him here. We also joining us at some point in time is Kevin Peraino. Yeah. Love the Peraino. The guy is chief lending officer at PRMG. KP is one hard guy to keep up with. He's probably wrapping up another webinar as he's trying to join our webinar here, but we're looking forward to having it. I'm really excited about getting into so many of the topics that we're going to be talking about, the strategies, the ways in which you can, increase revenue, and we are needing to find ways to do that. But let's first of all start off by looking at what the economists are saying about the economy. If we could go to the next slide, please. Fannie Mae is out here saying what it is saying about the forecast. Now, we are going to do a lot of polls through this webinar because we want customer engagement. So get your fingers ready. If you're watching this on your cell phone, get ready to thumb it out. If you're on your computer, get ready to start making some shares. So here's our first poll. What are your projections for your organization in 2024? There are 3 answers we're going to be putting out there. Gain market share. Is that grow your business? We're going to be talking about keeping the lights on. And the third one is it's not looking so good. We're going to run that poll in just a minute, but let's take a look at, first of all, where these projections are at. I look at Fannie Mae and Freddie Mac. Got great economists there. Doug Duncan is one of the most celebrated economists. So I do pay a lot of attention to this, especially when you start looking at which one of the ones to believe. What I love about Doug, I recently had him on my podcast, Delfino, and we were talking about what he sees is the market. And I'm encouraged. Take a look at that. What's circled on there in the fourth quarter of 2024 is 5.8%. You listen to the podcast and the recording I did with Doug Duncan, Les Parker, and Adam Quinones and Matt Graham. We talked about this could actually manifest sooner than that. So this is a conservative, and we're looking at what's going on in the markets right now. But let's go ahead and run this poll that's up there and running right now.
It's running right now. Panelists can't vote, so everybody else is getting their votes in.
I tried to vote, Richard. I tried to vote. Yeah.
I think we got a quorum. I think we got a quorum.
There you go.
And we got KP that joined in. He set a new record. Okay, good. So we got the poll results. Thank you. I love you, KP. You just cracked me. So good to have you joining in, bud.
It's crazy. It's like I'm wrapping up an investor call, with Social Coach, and then teeing up the Mortgage Innovator Conference for California MBA. And I told him, I was like, hey, everyone, I'm hopping on with David and Richard and Delfino. So you got to cut me some slack. So anyway, thank you guys.
There you go.
Well, it's good. It's good to have you here, sliding in at the last minute again. Well, we're glad to have you here. What I'd love to get is real quickly, can you give us your take on the forecast that we have up there?
Well, I want to make sure people got their poll answers in first, and I'm glad. So let me just
gain market share. Everyone's looking at the gain market share, 74%. I agree.
Well, I mean, we're still here, right? Like we're still standing. It's like my avatar. You've been fighting your back to the gates of hell for the last year and a half, and you're still standing. And sadly, in that movie 300, everyone dies at that gate except one guy. But for us, we're still here. So you should, just because of attrition of your competition and because 50% of mortgage loan originators did not renew their license in the last 2 years, we should gain market share. The market will grow. If you need validation, look at your lock pipeline. You probably haven't had a January lock pipeline look like this. Your locks are up in January. Cold, crappy, wintry, non-seasonally purchase market January, your locks are up compared, to December and November. And so, it's all right there in front of our face. And I will tell you, just to put a bow on this comment, the difference between me being at the New Orleans IMB, the Independent Mortgage Banker Show last week, put on by MBA, and the vibe and feeling in October, the national convention in Philadelphia for the MBA, when rates were at 8%, the highest they've been in my short 23-year career. People back then were doomsdaying and survive till 25, which is a stupid thing to say. It's only for commercial real estate. And then this last week in New Orleans, everyone was fired up. They were excited. They were ready to go. They were positive. And so I hope people are feeling it. Of course, rates don't go up or down in a straight line, but the trend is for rates to go down and business goes up.
And I love this number that's up there that Doug has put up there, Doug and crew at Fannie Mae, 5.8. That's encouraging. Fourth quarter, I think we could actually see that sooner than that, KP. Your thoughts on sooner?
Yeah. So interesting, I've been watching the 2-year treasury yield, right? So I know we watched 10-year for rates, but when the 2-year continues to collapse and come down, we got like within 15 basis points just the other day. When that 2-year gets uninverted, there's now money back, right? There's profitability. People start to get a little bit more liquid buying mortgage-backed securities as institutional investors. And that's what brings in profitability. That's what brings rates down, and not to get super technical, but, there's a huge spread between the 10-year yield and the 30-year mortgage fixed rate. And, it's been hovering around 200, 300 basis points all this time. It's really, it should be a lot less. It should be around 170. And I think, maybe even 150 historically. So you watch a couple of these like technical signals, they'll show you ahead of time where rates are going to go. And it's usually predicated, based on economic data, inflation data, and what the Fed says tomorrow. And then the next meeting, March 20th.
We could go on and on. This is your sweet spot, KP. Watch
you
KP's video. Watch we all do this. It's good stuff. Watch KP's videos. It's awesome stuff. Let's move on to product mix. This is a big topic. And Delfino, this is really an interesting topic. And I want you to cover what it is. And we're going to do a poll in just a minute. But first of all, let's talk a little bit about product mix before we go into the poll. If we could just do that real fast.
Yeah. Let's talk about it. And KP,
well, it's already, the poll, I guess, is already up there. So people can ask about it. But if you could talk about it, great.
Yeah, no, definitely. And you know, I echo KP's comments as well. I mean, more importantly, is having that positive mindset, right? That we made it through. We're all trying to grow. But I think as a lender, you know, we're really focusing on trying to have the right product mix. And as margins have changed and the world is kind of changing a bit as well too, you know, we've really looked to expand our product base, especially in the non-QM space. I've seen more and more lenders get into that space. For us, the product, and I think for the industry, is education, educating our customers, our brokers, our sales teams, our underwriters, really driving that and surrounding ourselves with a good team that understands that product, right? Being able to fulfill it and being able to offer that service to our customers. We recently hired somebody in our company, Will Fisher, who in the non-QM space is well known. He has a great background in that. Right. But I think for us as lenders has been really trying to educate our broker base, for example. Most of them might not be too proficient in that non-QM space. Some of them are learning as well. So for us, our focus has been making sure we're educating our customers specifically on the non-QM space. And I don't know, Kevin, what your thoughts are on that.
Yeah.
We've been pretty heavy in the non-QM for about 5 years in-house. We have our own dedicated team, education team, content. So I agree with you. Yeah. We're a 3-channel lender, so about 900 loan officers in retail, and then correspondent, both delegated and mostly non-del, and then of course wholesale. So yeah, I agree with you. I will say one thing just to kind of add some color, is that non-QM was my biggest. Like, if I had a top 3, what should originators be doing? A year ago, when people were asking that question, in my top 3 was learn non-QM. I think in March of 20, when the pandemic started and the secondary market completely melted down, you saw non-QM loans just go away. They literally just disappeared. No one was buying them. It was frozen. It was done. Now, I know this is kind of unpopular, but Dodd-Frank worked. Okay, so in that regards, having a qualified mortgage, which is Fannie, Freddie, and Ginnie backed, which is our overwhelming focus at PRMG, especially this year with, all that, businesses coming. But, those loans, which are deemed, a little more risky, not as liquid, they disappeared and kept the integrity of Fannie, Freddie, and Ginnie intact. And so they didn't take hits because the borrower one day out of bankruptcy got a loan and decided, well, I'm just going to default again. And I know that's kind of, I'm not trying to make an unfair assessment, because non-QM loans actually perform very well, and their loan amounts are actually very high. But after that market came back, I think the originator at that point, especially with volume being down the last year and a half, said, okay, this is a viable product. It's not like, hey, let's do solar loans because things are busy, or let's go do second liens because the loan amount's $50,000. And I mean, it's like this is a viable first lien product that it has legs to stay. And I think with more entrants and more liquidity, I think it's worthy for all of us lenders to invest in resources, education, pushing it, and communication about it.
Yeah, that's really good.
I think that's really the biggest part, is the communication, right? And making sure that everybody understands the product, because there's so many pieces of it that changes. Even it's changed over the last couple of months, right? So for us, that's been a big focus on it.
If you could take one quick question, Delfino, take a quick question from Dana. If you could look at the comment section there, read that and respond to that real quickly. I'm trying to meet as many of these questions while we're on topic here. We can try to address the ones we miss at the end if you want to stay there, but it has to do with business purpose lending. Is that considered alternative mortgage product? Is that under the alternative? Your thoughts real quick?
I think the pieces of it can be. We're not offering that type of financing right now, but I'm sure some lenders are. We're more focused in the bank statement, DSCR coverage ratio, P&L product. We even have a full doc product as well too. So there's a lot of pieces in that non-QM space. We haven't tapped into that market. KP, have you guys tapped into that?
Yeah, I would say generally I agree as well. Although we do lend on businesses in the cannabis industry. Okay. So, maybe that qualifies if that's where they're getting at. But other than that, we're not doing SBA loans and stuff like that. But we do have some niche stuff. Some non-QM nuggets, and the niches are in the riches.
Yep.
Niches are enriches.
Everyone's
And
different.
I think that when we're talking about increasing profits, that's really important. Let's move on to the tech stack. It's an important topic.
Yeah.
Never has that been more important. We say tech has always been there, but we want to get a poll again on a scale of 1 to 10. What is, I've got to change my slides up here that I'm looking at. The scale 1 to 10, how would you rate your tech stack in terms of ROI? Remember, we're talking about ROI. Are you getting the investment that you want out of this? This is a big one. So Richard, I'd love to this is a great opportunity for Truv to talk about how you can save so much by using Truv on the verification side. Richard.
Well, actually, this is actually a question I think for KP. I've worked with KP in a former life and at the current company I'm at right now. And his team, Robin is who I'm calling out, is fantastic at actually quantifying ROI. So my recommendation for anybody in the audience when they're thinking about how to quantify their ROI is, if you're working with a vendor, don't just take what they're giving you as the ROI, because they're going to use their calculations. You really want to own that number. And I think that's true with all things in life, right? Like, you should be invested in knowing and controlling that conversation. And so the first step is just to come up with some assumptions and calculate an ROI for every one of your pieces of tech, and then be prepared to defend them against other people, bounce them off people you respect. Like, you got KP and Dell on here who know a lot about what they're getting with different ROI. I'm going to share the results really quick, and while we're looking at those results, I'm going to just do 2 quick slides on Truv. Just as my only part of the whole presentation.
Interesting. Look at that. Look at those results. Yeah.
Look at those results, right? I mean, that's interesting that I mean, it's right in middle. I would say it's kind of like right in the middle, right?
Yeah.
5 to 7. Most people are kind of ho-hum about their tech. Well, so look, we were at IMB. KP just called this out. We were at IMB and the topic was credit and verifications. Everybody's feeling on December 31st, 2023, the cost to pull credit went shooting up for all the IMBs. Everybody's feeling it. And that's what everybody was talking about at the conference. They were saying it's tone deaf at this time of the, right now in a high interest rate environment to be doing that. And the same for verifications, right? Some people don't like calling it out, but I don't mind calling it out. The cost for the work number's gone up like crazy over the last couple of years, and people are hurting because of it. So this is what Truv does, right? We do verification of income, verification of employment, verification of assets, and insurance. And we can get into that if you want to learn more. I'd reach out to Truv, but just at a high level, we got 92% of the U.S. workforce covered. I think most people are loving to see that we're a Freddie Mac AIM approved provider, world-class conversion. The product just works. It's awesome. It's slick, and some of the highest ROI out there over, the savings over the work number. So what I would say is this: you got the QR code on the screen right now. If you want to learn more about Truv, reach out to us. We'd love to have a conversation with you. And then without further ado, let's stop and get back to our presentation here on education. Delfino,
I think we're on the
great
tech
thoughts here.
stack. Maybe we can have Kevin share KP maybe some ideas on the IT piece.
Yeah, good call. Let's just talk about the results really quick.
Yeah.
Okay, sure. Yeah, I mean,
We lose you, Kevin?
KP muted out by accident.
Yeah.
KP. Well, we'll have to wait till he finds his unmute button. Would love to get his perspective on it. One of the things, Delfino, that we talk about as one of the strategies is number 3 is education. This is a big one for you, and I love that. Why is education such a central point of your 2024 strategy? I love what you share on this.
Did I go mute? I apologize.
You did go mute for the first time ever, Kevin.
Oh, you know what it is? Okay, I'm a big Android fan, and obviously we have a lot of Apple Android haters on here, and I will give you all some ammunition. I don't know what it is, but when I'm on Zoom, even though I have do not disturb, if someone calls in, it blocks out my audio. It's super annoying. Anyway, what I was on kind of a roll there. Let me finish the thought.
Yeah, finish your thought. Go ahead. We'll go back to that. Yeah.
So 2 years ago in February was the lowest rates in the history of history, and they rapidly went up to June of 22. And so the first half of 22 is actually decent, but then everything kind of froze, right? And so a lot of C-level executives, they started going into cost-cutting mode, and we still have plenty that are in cost-cutting mode right now. And so you have to make a shift into your investment and your ROI not just a hard dollar ROI on cost cutting, but also ROI and getting new business. And so some people wait until the market turns and gives back. So they're waiting to get back to profitability or get back to a certain level before they invest and spend money on something that can create sales ROI. So there's still a lot of focus, though, I would say, on cost cutting ROI right now. But the tide's turning. So if you haven't already made that shift, I would say make that shift if there are any C-levels out there listening.
That's good stuff. All right, Delfino, your favorite topic, education.
Education. Yeah, as we were prepping for this webinar, we spent some time talking about this. And for us, it's like a 3 pieces to the education puzzle, right? Obviously, a big part of that is educating our teams, both operations and sales. So we have a training department that really handles, calculating income, tax returns on a monthly basis, refreshing. Believe it or not, we're going to get back into an EARL market, or VA streamlines are going to be popular again.
Good point.
We start to see rates. So, when's the last time we've all done a lot? We've all closed a lot of VA EARLs and streamlines. It's been a minute, right? With rates where rates have been. So we're spending time educating our underwriters, our sales teams as well, both retail and wholesale, spending time educating them, helping them how to explain our products. And also, but more importantly, in the TPO space, our brokers. So we've had series in both non-QM, conventional, and our government products, where we have a series, for example, of educating how to calculate income. Specifically, you see a lot of variable income out there in the market, and some loans are even more challenging and so forth. So we set a series for our brokers to attend, not only for non-QM, going over our non-QM, how to look at bank statements, but also looking at how do you calculate income on a VA loan, helping them with BAH, whatever they use to qualify, or like I mentioned earlier on a nursing, for example. We had a lot of requests. So it wasn't just us saying, hey, you should learn this. We actually put a poll to our customers. What are some pieces that you want to learn about when it comes to this? So how can we help you support? So it's helped us reduce mistakes, right? Help us close loans that are a lot faster. But I think being able to educate our partners has been a big piece of our success and our big plan going into 2024. But it takes 3 pieces, right? It takes the sales side, loan officers, account executives, the operations piece with the underwriters, and then also our customers as well, our partners. So that's a big part of what we're doing this year. We have another series starting on Friday. We have a training for EARLs and streamlines, like I mentioned. That's a big focus of ours in 2024.
Well, I have a quick point here. KP, I want you guys to you have to opine on this. 35% of the people in the audience here just said that they don't think their team's able to calculate income consistently and accurately.
Yeah.
That's a huge percentage.
Yeah. If you think about it, it is. And that's why we got to have constant training, right? Educating. And if there's a trend that we're seeing out in the market, we like to get ahead of it. If we see something coming, if we're seeing more type of product for whatever reason, we're really trying to get out there and get ahead of it with education. It sounds like it's an easy thing to do, right? Educating, making sure everybody knows, but you have to be detailed. You have to be strategic on what your offering is and bring value. And that's what we try to do for all of our teams.
Yep. That's really good. Jim Harrison just echoed in what you're saying. Well said. I think training, what is there real quick trip? How are you doing this online? What do you find to be the most effective way?
So,
and how long are you doing it for? Is it an extended period of time? Is it more frequent? That type of thing. So
it depends. I mean, we're dealing with, salespeople sometimes and brokers, right? I think you have to be very strategic. I don't think you can go longer than 30 minutes. We keep them at 30 minutes, right? And we break it into sessions. So it's not just a big piece on overtime or self-employment tax returns. We'll break it down into 2 that we can explain and take questions. We'll send the recording out to our customers as well too. But I think the biggest piece to it is making sure that you're adding value, right? Like if you can come out with your training and there's no value to it, people are not going to want to join the next one. So we actually go through live examples, right? Like this is how you would calculate it. This is how you should look at this kind of variable income, whatever it is. I'm a little old school, David. I like to be out in the field. I travel a lot, just like KP. He attends a lot of events. I attend a lot of events. I'm in Texas next week. I think training in person has been kind of lost a little bit ever since COVID, right? So we just brought in all of our customers, for example, into Southern California, the Southern California ones, for an in-training Cal Alpha training, right? That was great. And there was so much value and so much great input.
Yeah, and there's ancillary value too. There's
Yeah, there
additional
is.
value just
There
beyond
is.
the education. It's getting people
Yeah.
together and talking. I
That's
think that's
right. That's right. But the
such a great
majority,
point.
the majority of them, excuse me, the majority of them are online in Zooms. I would say that probably 80 to 90% of them that we do are online.
Love to get your thoughts on that, KP, but we're all running. We're only on strategy or thought number 3. Let's get on to number 4, data quality. Why is increasing the accuracy of data so important as we look at your strategies for 2024? KP, this is right in the middle of your wheelhouse. I know you've got a few opinions on this one.
Yeah, I mean, a few years ago, everyone's like, "Oh, data is the new oil." Like, what the heck does that mean, right? But if you look out there, the data scientist is like your highest entry level job. For people coming out of college, you talk about data, you hear it, and why is it so important? What's going on? I'll give an example. So I was with CoreLogic, and they said that they have collected a piece of data on every property in America. Okay, just for example, the volume of room in the floor, or the first floor, or the height of the ceiling, right? Does it have vaulted ceilings versus not? Now, that's not necessarily a data point captured on an appraisal form, but we all know, being in this business, that's an appealing data point, right? So you're collecting this data when you take all these pictures of these rooms and scan and make these measurements, and there's this dark data that is collected and you have, but you're not putting it to use. That's a pretty powerful thing to be able to kind of take and quantify, like, all right, well, how much more per square foot on, the footprint of the house, and how much more valuable, how much higher can I set my price, knowing I have more volume in the house or higher ceilings in the house. And that's just one little piece of data, right? And so there's so many, so you have to have, first, I would say most lenders are now in this position, but I would say, gosh, even 5 years ago, we're not in this position. You have to have a data warehouse. You have to have a warehouse where you store whatever you collect. And then your data team in-house can create an API and do a single purpose report to give to any technology partners that want to tap in with you. I want to partner with someone like Truv. They want to give me information regarding employment or income or whatever, that we can share it back and forth and map it to certain places. You have to have a process in place to do all these things, to make underwriting go faster and be cheaper and be better. And so that's you hear data, and then you start thinking it's the same thing as AI. Like AI. Well, what does AI mean? Well, I mean, if you don't know what to say, type something in a prompt and give ChatGPT a chance to like crank something out in 2 seconds and go, okay, all right, now that gets my gears going. Now I can kind of put it in my own tone. So it's obviously, having accurate data, lots of data, a formula to collect data and then put it to use. That's where a lot of our emerging winners will be coming from in the landscape over years to come.
Yeah, Delfino, quick thoughts.
He said it best. I don't know what else to add on that. I think data is important. Go ahead, David.
I'd say I've got one other thing to add to the data quality is also data. When it comes to this, is business intelligence. It involves data. Where are we lending? Why are we lending there? You look at, there's so much not only do you look at the data you're collecting in your 1003, the data, the richest document for gathering data on an individual that you could get. That's why we got to work on also data security, but now the whole other topic. But where should we be lending? So it's data about the markets, and we have never had so much excellent data about the market. So I just want to put in a plug for data intelligence. We could go on and on this one. Good comments on that, KP. Let's talk about 5 common mistakes. How are you minimizing common mistakes in your loan origination process? Delfino, let's start with you on that and then get some feedback on that from KP. What are your ways to save money?
Yeah, no, I think that we've obviously seen the market change so much, right? There's been a lot of changes in the market in different products. For us, I touched on the education piece, but us is finding the right partners to partner with the tools, right? And making sure we're up to speed on all the technology that's out there. That's been a big one for us too, in mistakes. One of the pieces we put into as well too is having the right tools for our ops teams with checklists, right? Making sure that's going through the process, making sure the files are coming in as they want, from submission to funding, right? It might sound easy, but really maintaining that checklist has helped us reduce mistakes and minimize the easy pieces. VOEs, right? Making sure we're following. VOEs has been a big thing for us, right? And there's been an increase in those costs as well too. And for us, one of the simple tasks we've done is making sure there's a validation process after it's done at the first end. So an account manager will do it, and we have somebody else backing it up during a certain time period. So
well, this fits really hand in glove with your education passion for education too. I mean, this is one of the biggest ways to eliminate the mistakes is through education, but it's also how you're monitoring it. Kind of goes into the data component, which is the previous one. KP, your thoughts real quick.
Yeah, I'd say income calculation is our biggest one to tackle. It creates the most cost down the line with repurchases from the GSEs. It has the most back and forth and inefficiency within the process. And honestly, it has the potential to be the most easily solved. If I'm getting information from an employer through a vendor out there and I'm tapping straight into the IRS, well, I don't need to worry about educating anybody other than the borrower how to upload their information. If I'm getting information from the employer via a great vendor, well, then I don't have to worry about that, right? So for me, there's all this back and forth. Delfino and I, our companies both do a lot of bank statement loans using a bank statement income calculator up front to upload all 12 months of bank statements, or just get the data straight from the bank when the borrower gives you their username and password and it calculates it. And then that income is imported into the system. And then everyone's on the same page. Borrower, loan officer, processor, underwriter, most importantly. And then it's also agreed upon by the end investor ultimately that they like the income because, hey, it's the same bank statement income calculator the investor told us to use to sell them the loan. And so all the back and forth, all the guessing, we got to take as much of that out. So then we focus our time, the one commodity we can't get back, on the harder stuff, the exception processing, the things that you can't automate, right? And so that's where we're going, and that's probably the biggest one I see is income calculation in the loan origination process.
Yeah, really good point. And then it's a great plug for Truv too. I mean, if you're going to go out and do it, when you can download it from Truv and save 80% over the other vendor, they're no longer leading. I don't think Truv's taking market share fast and furious because of the cost savings. So it goes back to that. Let's go on to number 6, speed. KP, you touched on this as we were talking, and it gets us into another poll question, surprise. But when it comes to speed, what parts of the loan origination process are you most focused on in terms of increasing speed? KP.
Well, yeah, for me, as a partner and a lender, a 3-channel lender, it's underwriting. I mean, underwriting is where all the heartache goes. So like that example, that I just talked about, doing income calculation, all those are real life heartburn, headaches. And think about, Delfino and our companies both have, wholesale channels. Now you're dealing with a third party originator. So like your process has to be on point, right? So that way, you get the next loan from that third party originator. They're like, oh, okay, speed shows you care. And I think that's it's a crazy, thing to think about. But I saw someone at some speaking event a few years back, and he was saying, today's client, especially as they skew younger, if you want to show them you care about them, speed shows you care. And I thought that was interesting. It wasn't like, me getting on the phone and saying, oh, I'm so thankful for your business. And they don't care, like the care, they don't, disregard that. But speed shows you care. That is the thing. And for us, the biggest hang up out of all the ones that I see up there is usually underwriting.
Yeah. Well, how do you?
I just got to throw this out here, KP. Document collection was winning, and you started talking, and you influenced it to underwriting. I don't know. I think there was a correlation there.
You're a pole mover, KP. You're a pole mover. Look at you.
You're a pole mover. Yeah. Manipulator.
You're on mute. Wait, he's on mute.
Manipulator. He's a manipulator of the polls. All right. I love that so much. Yeah. But how do you reconcile that, KP, along with what we were talking about, just a little bit about accuracy? When you deal with speed, where's that point where you start tripping over the accuracy point? How do you solve for that, KP?
Well, that's the whole point of being, having data partners and being more data driven, right? And so I don't have to worry, about accuracy if I'm confident in the source of data. If we've been working with Truv here for a while now, and it's got a great reputation within our walls, and it's gaining market share within our walls. And same thing with the bank statements. Like if I'm logging into Bank of America and I'm getting the information straight from Bank of America, I trust the data. And so that's where I get the accuracy.
We have the speed. And
Yeah,
it gets
and
you
the speed.
Yep. Great point. Undisclosed debts is what Tony put out there. Yeah, absolutely. Anything you want to add to that, Delfino?
No, I think you said it best. That's an interesting comment that you said about the younger generation. Go faster and they think you care, right? And I think
that's true. That's so
that's
interesting.
Yeah, it's interesting. I think to them, I think it's really important to get that great mix of quality and speed, right? And I think that's all we're looking for, right? Is having great quality and having that speed aspect. Like he mentioned, we're in the TPO space where turn times are important. That's how you get your next deal, right?
Yeah.
But
Yeah.
also to stay in business, you need to have great quality too. So us finding that mix, those data points is really, really important to us as well.
I see some comments about document collection in there. And just on that point, I don't want to collect documents. I don't want documents. I want data. Right. And so the whole point of getting more data driven is to collect less documents. Collecting documents inherently is a problem. It inherently is an issue. And it's usually the borrower that is kind of slacking. Right. And so, do you have a point of sale that makes it easy, right, and efficient? Do you have some kind of way to take more data and less documents? Do you have some kind of, borrower portal that walks them through how to upload this and it's super quick? They could take a picture, do it from their phone. And then your document ingestion system on the inside as a lender, do you have something that's on point? Does it have ADR, automated document recognition? Does it go a step further and go into data scraping or even OCR and start pulling data into different fields? And so, document collecting is inherently a problem. And so we're just trying to avoid it altogether.
Yeah, good point. I'm looking at the time, trying to keep this on as a moderator, moving along. Let's get on to Matrix. Delfino, we've all heard managed by the metrics, KPIs. It's such an important thing. We've got another poll question up here. But how are you doing this to reduce costs and increase revenue, Delfino?
Yeah, no, thank you. I think we touched on almost every piece of our conversation has been data, right? So if you can measure it, you can manage it, right? So I think for us has been really the reporting is critical to us, right? Like we have on your screen here, average loan cycle time. That's important. Making sure we have the right pull through. That's extremely important, especially as rates drop. Kevin talked about our locked pipelines. He's right. Like it's our highest locked pipelines. But if you have a dip in rates, everybody in lenders on our side are switching pipelines, right? If they don't have a float down policy. So that's something we monitor greatly on ours is the data points, making sure underwriters are hitting their mark on a daily basis, conditions are rotated at the same time, and it comes down to the speed part too. Somebody made a comment here about collecting the data, collecting documents. For us, KP mentioned too, like we don't want to, data is important too, but collecting conditions from our partners and borrowers, et cetera, is starting to be a little bit more of a challenge for some reason, right? So making sure we get the right information at the right time has really helped us kind of close our loans faster to help us with that cycle time. But I don't know, KP will agree probably on this too, but really making sure we're telling our teams what the metrics are so they are aware of it too, right? What the expectation is really important. So I don't know, KP, if you got anything to add on that front.
Yeah, definitely. I mean, it's a great time to circle back on a repeat question on the cost per unit. And by the way, on that alternative product, I mean, anything investor, to save hard money, we're doing investor loans. I know you guys are, we are. So the alternative business purpose loans. So cost per unit, you see these numbers that the MBA puts out. Overwhelmingly, that number, that cost to produce a loan is the originator's compensation. So it is the originator who hunts the loan, finds it, and charges a point or two, or the margin overall in the origination part of the cost to produce. So the operational expense of a loan, let's just say it's $3,300. Okay, if that's the average to produce a loan, that's average in the mortgage landscape. We've been trying to we've been having some good months around 2,800, 2,900. We have certain loans, for example. Yeah, it's great. I mean, and we have some loans where just the underwriting piece, if it fits in the green path, which we're about to get a lot of green path happy loans coming up here as soon as the Fed cuts the rates. We use some offshore for that. And then on every offshore loan we also have an onshore resource to clean it up and communicate with our clients, whether in retail or wholesale correspondent. So I'm $50 offshore to underwrite a file and $25 for the onshore resource. So it's $75 just to underwrite a loan.
if it fits that mold. And we're even doing, some simple self-employed bars, not really any FHA bars, unfortunately, just because there's kind of regulations on who can underwrite government insured loans. But we're about to be in that environment where there's a lot of cheaper loans, and cost to produce will come down in all these stats for Q2, Q3, and Q4 as soon as the Fed cuts the rate. So that's our cost to produce a loan, but that includes everything. And to be honest, like, we could be way less. We have chosen to invest in our people, and we still remain slightly overstaffed because we think, well, one, we're already getting busy, so that move was justified. And spring is busy for us. And so this year, when the spring comes around, I think what a lot of C-level executives are going to do is they're going to try to hold their staff as long as possible without hiring. Maybe they flex with some technology investments they made. Maybe they flex with some offshore resources that are kind of there as backup without having to hire more expensive and pay up for the people that do the operations. But then see where we land when spring purchase season is over. And my guess is by then the Fed will have cut, and we'll be back into refi land with even a little bit more late year purchases with lower rates than we normally see. So that's how we're thinking about cost. I know the lowest number I've ever heard for anyone to cost to produce a loan is around $1,500, maybe $1,450. But that's cherry picking loans, doing only the easy loans, setting up an assembly line. That's a different model. Our model, we're let them go fight and be number one. We fight in the community. We've got branches in the community. We serve the underserved. We do manual underwrites. We do tough stuff, and that is more expensive to produce. But that's what makes us happy. We love serving our communities.
That's a whole webinar just in of itself. We've got
that is, but
we've got clients that are producing and quality and doing a broad, diverse product mix and doing it under $1,000 per loan. So when you go like, how the heck are you doing that? But that's a whole nother topic for another way. Let's get moving over to number 8, the F word for every mortgage lender: fraud. I want to ask KP and Delfino. I want to ask you, what are your current trends? What are you seeing? There's been reports in the press about reports coming out about increased fraud. What are you seeing in your shops, and how are you working with it?
Yeah, you want to take this?
I'll just start. I mean, it's definitely up. When business goes down, people cut corners.
Yep.
We've seen some straw buyer stuff. So it's out there. It's less than, I would say less than 1% of our book. But
that's good.
But if you do we did 22,000 loans last year, right? So that's a significant number.
Yeah, when you have more volume, but that does help. That does help.
Yeah.
We're starting to see it quite a bit too, and when it happens to us, we educate our brokers on what we see, right? Like, I think that's a big thing. Obviously, in the retail channel, they're aware of it. They have processes in place. But it's in the TPO space specifically, we'll talk to our customers about it. We're seeing a lot of bank statement stuff happen, even, believe it or not, and some income pieces, but more importantly, assets. We're seeing that quite a bit, actually, and that's been on the rise. I would say I've seen it right 30%. So that's something we're cognizant of. We have tools in place to help us with that in the underwriting space, right before funding, et cetera. But for us, we have seen an increase, but education is something we've all talked about here a lot of time. But once it happens, what do you do with it? Who do you tell? How do you share that information? And how do we protect ourselves as a lender?
I want to be respectful of everyone's time on the webinar here. We're wrapping this up. We got 2 more strategies to go. Let's talk about team. KP, you've already talked about a little bit. You touched on this. If you wouldn't mind, touch on again. Delfino, this is one of your favorite topics. You're all about team, Delfino.
I am.
Both you guys are that. You got great teams. But you talked about being overstaffed, slightly overstaffed. KP, let's start with you real quick.
Yeah, I mean, I can give two real world examples. I mean, there are some cutthroat businesses out there. Let's just say Amerisave, for example, right? Just naming names. Really a consumer direct lender, right? And this is my opinion, does not reflect the opinion of Kind or David or anyone else. But, they took a very hardcore approach on their third-party origination channel. And the owner just called up, Mike over there, who was running it, and said, shut it down. And he's like, what? He's like, yeah, just shut it down. Shut it down now. He's like, well, give me some time. So, to be fair, I mean, like, that guy probably saved $50 million. Okay. So he fired everybody in his team. Okay. Yeah. Okay. Yeah. But I mean, look, so that's one extreme, right? Obviously we didn't do that. And I would say on the other side is, you kind of hang on, which is mostly what independent mortgage bankers do, like us. We hang on longer than we should. We're hopeful, we're optimistic. We think the market's going to turn any minute. And it took a year and a half, and it still hasn't quite turned. And so, so like I said before, we're investing in our people, and we think it's okay, because when the market does turn around, we want to capture a lot right away within those first 2-3 months when it's really, really crazy. And you know what? We can sleep well at night. We held on to people. We put bread on their table for their families, and they got a roof over their head. And so I think there's those two different extremes of how, and let's not forget, I mean, Delfino, you and I will agree. So at the end of 22, we were the 10th ranked wholesale lender in the country. We're 10th. 5 of our competitors in front of us went out of business, out of business, right? So, not going to get into each one of them, but I don't know what their strategy, what they were thinking, but they weren't all in, and they're not here. So this isn't a post to brag that we're 5th. The point of bringing that up is that, at least in wholesale, some of these lenders didn't have the stomach or the intelligence or the wherewithal or the care to remain in the business, which required you to lose money, aka investing money, to be here and ready to roll the moment it popped back up. So we paid our dues as a lender, but we're here in those channels and all channels. And it's just a different approach, how you look at down markets. And not everyone is built the same. So I know
that's a great point.
Glenn Stearns, personally, you work for an absolute legend, Delfino. He's a great friend, and I love what you guys have done at Kind. And he's all in. There's a few of us that are all in, and we're ready to rock. And this market's turning in our favor finally.
Yeah. I couldn't agree with you more. We're excited for this market, and I think like every lender, when the downturn happened, we obviously had to adjust our staffing levels. But I think one of the best things about one of the things we do is when we're growing, we're hiring now. We can't hire fast enough. Actually, I think we're preparing, like you mentioned, for what's happening in the spring, Kevin. And I think the first thing we do is call back the people that we had to adjust last year. So that's the first step. Go to them first. How come we're going to bring them back? We have brought back 90% of those people, right? They want to come back, they come back, right? So that's a big deal for us. I think our teams, all of our teams, a great team at PRMG, all the companies on here, is our teams make us who we are. And I think that's a big piece. They're all our competitive advantage. And we focused out here in Kind, and making sure they're feeling comfortable, making sure they're feeling productive, and the best way for us to support them. So we're hiring. I know some people are looking for people as well too, but it's a good sign of what's happening in the market.
Great. That's almost a good note to end on. We got one more to go, and then we're slightly over time, so we'll go to this one. Customer experience, man. It's at the end of the day, all about the customer. Let's get this whole question out there. Where does the borrower experience stand today from your perspective? Delfino, let's start with you and wrap it up with KP.
Yeah, no, for us, I mean, respectful time. This could be a whole webinar itself too, David. But
every one of these points.
But for us is 2 things, right? Number one is setting the right expectations. That's important.
Yes.
For everybody, right? Setting the right expectations for your borrowers, your partners, making sure they understand the process. That's a big piece of the customer experience too. And specifically in the TPO space is your technology. We focus a lot of our experience on technology with our portal, with some of the pieces of the updates that we're doing to our backend for the underwriters on the condition process. All these little pieces make us who we are as a lender, make us as a lender who they are. So we've really focused on the communication, really making sure that they set the expectations both internally and externally. So we really just strive on that. And we really try to have the best in technology, right? There's a lot of lenders that focus on that. There's a lot of great tools on that, but we actually built our portals, our technology on what our customers want. We didn't go out there and say, you will like this. We say, would you like this? We pulled our brokers.
Asking the question.
Good for you. So that's big for us. KP?
That's good.
KP? Well said. I mean, I think, we built a type of lender that is really good at exception processing. So helping with manual underwrites, helping with down payment assistance programs, helping with loans that are that require customer service and personal attention, picking up the phone and walking through it. And so when you build a system like that, you're not over indexing and trying to be the best at the easy peasy stuff, the assembly line stuff, the slam dunk refi. Having said that, we think we have the best balance of both. And to your point, Delfino, we agree with you. You've got to invest in technology. Yeah. We spent the first 6 months of last year going to a best-in-class product and pricing engine. We're on Poly as our pricing engine. We're just in the middle of testing our brand new TPO portal to serve both our correspondent, non-delegated, delegated, and wholesale channels. And we're going to be first to market with a portal that we think is best in class. And so we agree with you. You have to invest in these things. You have to get data driven. You have to get all these things tied together, have a process that's seamless and easy, but then also doesn't forget about the human aspect of it. And I saw someone in there, Gene, I think you made a comment, and I will agree. For some people, it's all about price, right? And so whoever that is, there's one person sitting at USAA, and you need to call that person because they're the only person with the best price. Just so you know, I guarantee you, whoever you're talking to as a borrower, there's 1,000 other people. You just got to keep making all the phone calls. You're going to find them, but there's only one the best, right? But having said that, for your average consumer, especially your first-time home buyer, they want help. They want help. They want attention. They want care. They want education. They want a seamless process. They want a fast process. They want it all, right? And that's hard to build. And that's why this business is hard. It's sticky. And that's what we're trying to build at PRMG.
Yeah, very good. Let's Richard, we went through all 10 questions. We've gone a little bit over. Let's get into some of the, for those that hang on. I'm impressed. We've held on to our audience, even though we've gone over a bit. My apologies.
Can I make a quick comment, David, while you guys look at that?
Please do. Yes, of course.
I just want to say this is that, one of the, thank you to you and Richard for hosting this, but I think it's great to have two lenders on here because I think this industry, we're stronger together, right? Sharing ideas and making each other better, iron sharpens iron. So I just want to thank you guys because we need more of this. We need more of lenders working together, right, in this industry because we are stronger. And there's a lot of great people out there sharing some great ideas. So thank you for that because it's a big deal for us.
Kudos to Truv for making this happen, bringing two outstanding lenders together and giving me the privilege to moderate. Richard, what questions do we want to focus on as we wrap this up?
Yeah, we had 3 or 4 questions that came in and I just wrote them down. So I want real quick, I'm just going to touch on them. Javon had asked first time home buyer products. Would you focus on those? And in this market, which products specifically or special services? Do you guys want to touch on that?
DP, you got that? Go ahead.
I mean, just being, involved in 3 channels for a brief 23 years, we see that distributor retail has a higher purchase percentage of business at all times, and especially first-time home buyer business. We see the broker channel not too far behind that, but let's say that if retail is at 92% purchase, we see the broker channel at 65% purchase, and then we see the non-delegated correspondent accounts. We see them at about 55% purchase, and so obviously that's a historical average. When there's only purchase business like there was last year, like everyone's at 89, 90%, right? So, but it's a different type of borrower. It takes a huge infrastructure to be in there, be educational, do the seminars, spend the time, make the relationships in your neighborhood, in your community. And so, supporting that is a whole different animal. And so I will say, other than products, right, whether it's non-QM or FHA, first timer, down payment assistance. I mean, we've got $200 million in Dream for All funds that we're about to start taking applications on February 1st, like literally in 2 days. And so we were the leading Dream for All Cal HAFA lender last year, a year ago, when that all came out. And, we're ready. The systems are ready to get up to $150,000 in down payment assistance from the state of California's Housing Finance Authority. That's an example of how we're doing it. And then we have a national DPA, whether through Chinoa or any of the other, funds that are out there. So and I'll tell you right now, like the home ownership hurdle, the down payment, it's only going to get harder. I don't know how the Fed thinks they're ever going to whip inflation, because the second rates come down, home prices go up, and then all the CPI numbers go up again. I think they're just going to throw it out and start using Supercore, right, which strips out housing. Because they can't build more houses. They're just going to have to say, hey, sorry, I'm sorry. And, inflation with housing is over our 2% target, but we're basically just going to have to say, if you're on the lower end, there's just no houses being built for you. So I had to strip you out of the calculation. Honestly, they start talking about Supercore, they've already teed that up. So unless our great builders had a great meeting with Lennar, they're having incredible traction building tiny homes, the 400 square foot starter homes. They're doing it in San Antonio. They're crushing it with that. And so I think that as the builders start to find a viable, profitable way to get houses that are starter level for the early buyer, for that buyer, to help get the working class at least gaining some wealth so they can ladder up later, I think, we're just going to have a problem with home prices until that's done.
Okay. In
That's
the
good
interest
stuff.
of time,
Yeah, we do.
two questions, one for Del, one for KP. That's all we got. All right. Occupancy fraud. Somebody asked, what controls can you put in place to reduce that? They keep seeing it. They don't know how to reduce it. What do you got, Del?
I mean, obviously, we use LSFM, right? That's a loan safe fraud manager that we use. That's a big part of us. I think it's really educating our underwriters on trends. Honestly, like anytime there's something, we have a loan committee, for example, that if somebody has a question regarding occupancy, that there's a committee for that. There's like-minded people. They understand the guidelines. They understand what to look for on that piece. We just had a couple of communications with some of our underwriters on that piece, specifically on occupancy, right? So we're starting to see a trend on that. But I think it's really keeping up with trends, and they're changing, I feel like almost every week, to be honest with you, right? But really making sure that they have those tools in place. We follow that tool that I mentioned as well as one of our primary ones.
Cool. All right,
Yeah.
KP. Last one, and I picked you for this, KP, because your finger is on the pulse of the economy so much. If you follow KP on social, hop on his LinkedIn, follow him on social. He's one of the most informative pieces of information I get personally, and so I would just recommend everybody go and follow him on LinkedIn. He puts it out regularly. Rate cuts. This is the question: how many rate cuts are we getting in 2024?
Well, okay, so I want to dispel a couple myths. Okay, so the first one's the most important one. Don't fight the Fed. Okay, so on December 13th, the Fed said they will cut 75 basis points in 2024. Okay, with the data that they had at the time. Now, I'm in the camp that inflation data will continue to get better as time goes on. If you look at the PCE data and the GDP report, which has its own quarterly inflation read, we are at 2% for the last 6 months. So months 7 through 12 ago is so high that it's keeping the number, at 2.9 and not 2. So in the words of Smokey from Friday, why are you bringing up old shit? That's what I would say. But what I would say is, as we go forward, that data will continue to improve, which gives the likelihood of the Fed to cut sooner rather than later. Now, they have to show their number again March 20th. Will it go up to 100 basis points? And by the way, 75 basis points or 100 basis points doesn't mean exactly 3 or 4 25 basis point cuts. If by May or July, jobs are breaking or it's softening or whatever the case may be, maybe that first cut's 50 basis point. It's just kind of a thought. A lot of times, more often than not, it is more than a quarter. They got to bring rates down to be impactful. Taking a quarter off everyone's car loans and credit cards doesn't help the poor. Taking it down 50 basis points helps the underserved. So I think the first Fed cut will be May, and it'll be 50 basis points. And I've been saying it for over a year.
There you go. Take it
Hey,
down. Write it down. KP spoke it.
Folks, thanks so much. KP has spoken. Del, I want to say thank you, KP. Everybody, they do this because they love the industry. They love what they do. They're not getting paid for this. This is just giving back to the industry. They love giving back. So thank you so much for doing this for us, guys. And David, thank you so much as well.
A joy.
Very much.
Thank you, everybody.
Thank you, guys.
Have a great
Cheers.
one. You bet.
Thanks,
Bye-bye.
everybody.
Peace out.